All right, welcome everybody. We're delighted to be joined again by Bob Vale, the co-founder and CEO of ClearStar, and David Pattillo, the CFO, and they are here to talk about the recently announced interim results, which are extremely good, Bob, if you don't mind me saying, but perhaps you're going to add a little colour about what pleased you in terms of the numbers and where you think the business has got to now.
This half, the first half of the year, we made some significant progress in the distribution of our medical information systems technology. We've seen some very strong growth there. The adoption of that technology, which is a mobile application, as all of our applications are.
Apps don't really work for the clientele you're trying to communicate with, is it?
Well, so nothing we do in mobile is an app-based. It's mobile responsive. We find that the downloading of an app for one use, as most of our clients will use, is kind of not really worth their time. The drug screening application has grown quite aggressively, mostly in response to the transient labor force as part of the new economy. We're very happy with that. We're very happy that we've got our expenses, our costs in control. That's been very flat for us. And our direct business has been growing very nicely. So all positive.
Mm-hmm. Any particular drivers behind the growth in direct, or is that you focusing on as an area, or the clientele again more responsive to that?
Well, the direct area is the newest area where we're going direct to employers to try to improve the hiring experience and then the ongoing monitor of employee experience. I think the investment that we've made in the mobile technology, paired with now the drive for the gig economy, and specifically our hiring situation right now in the States, where we actually have more jobs than we do employees. So we're trying to get out there in the field instead of bringing people into offices to apply for jobs and then hiring them on demand. We're very much getting an on-demand employment in kind of environment.
Mm-hmm. Yeah, well, that sounds a good background. So why do you think ClearStar is outperforming the market?
In a lot of cases, I think it's because how we look at technology. We look at our service of employment screening and background checking a little bit more progressively as far as getting a distribution of the needs of the technology in the hands of the people who are required to process background screening. We are very bespoke. We work with our customers to ensure that the technology meets their needs, streamlines their process, ingrains in their systems, and delivers the kind of decision making that they need specific to the job that they're recruiting for.
Mm-hmm. And you have quite a range of services, branded services. Is that now, do you think, a full portfolio that allows you to be sufficiently bespoke to any large client group's needs?
It's pretty extensive, and we do find that we add new pieces and parts or collaborative data all the time. So some customers need unique decision-making tools where we have to start to use other pieces of data. The origin of the data is not as important as much as how we use the data, how we transform it or refine the data. This is really about mining data, transforming it, and then distributing.
Mm-hmm. And is there any particular client wins that you've been pleased with this year, and to take that further, are you targeting larger groups, international groups that might be based in the States? It would seem sensible for you to look after the people who are doing the largest hiring.
Three-part question.
Only three. I've got
three-part question.
Reserve, yeah.
So where we're really happy is with our partnership with SAP SuccessFactors. We've built an integration through a third party that we partnered with, Veritas Prime, who does development for SAP. That allows us to integrate with their applicant tracking system, human capital management system, and transparently do background screening. The client that has probably been the most noteworthy, and this was an SAP client also, would have been Gulfstream Air. Gulfstream Air being a General Dynamic company. We're doing their vendor program, and they've been really a watermark in bringing us to the next tier of clients. I mean, that was quite a notable brand for us to be able to reveal. In most cases, our clients don't allow us to reveal their brand because this is part of their security program. But Gulfstream has been quite forthright in acknowledging that we're doing their screening, and that's been good for us.
Mm-hmm. Is that a rare occurrence for a partner company like SAP to directly lead you on to someone else?
No, quite the opposite. That's the trend. All of these applicant tracking systems, and they have different business constructs. SAP's is they work through third-party integrators, which is Veritas, and then they will look for background screening companies that can integrate. We don't have a financial arrangement with SAP. There's no money or referral fees. This is us creating quality in their product, relieving pain points, so the value of their offering increases.
Mm-hmm. Win-win.
Win-win.
Mm-hmm. And looking at the SAP SuccessFactors offering, touchless is a service that you seem very pleased to be functioning. Can you explain a little bit to investors why that's added value to SAP?
The touchless portion that we helped instigate and develop with SAP was really an issue of consistency and compliance. In the environment that the product was being used, there were multiple recruiters or agents across the United States that were doing recruiting for one particular client. And the problem the client was having is recruiters trying to get as much turn as possible, or instigating background screens on anybody they had really interviewed, but also at all different times. From a compliance standpoint, they were getting different instances of background screening that were not consistent. And it's very important that when we judge people or review people that we do it in a consistent manner, but also their pricing was going up. So we developed an algorithm that could be set in our system and passed on to SAP that would mandate per position when a screen was instigated. This allowed a touchless environment for the recruiters. Recruiters were taken out of the loop, protected the client because now there's consistency to compliance, and actually reduced their costs, making us more valuable.
Mm-hmm. Everybody can see where they are in the process.
Right, and this answers some of the questions we get on commoditization of our market. It's really not about the price of the services we offer. It's about the value we bring, which increases the use, which allows us to win business.
Very good. And how much do you think that the American market is going to be where you're going to focus in the next few years? It's obviously growing very nicely at the moment.
It is, and we represent data in over 230 countries that the United States does not hold sanctions against. We do support a lot of international companies. We have a very large business partner in Mexico called Multi-Latin. They do a lot of the new gig economy offerings down there. We support some companies here in the UK where we provide them their background screening, and we do a lot of data selling and distribution. So we buy data in all these countries, but we also distribute back to partners who want to consume US-based data. The economy is so massive right now, and the need is so well established, specifically in drug screening, that we've got a lot to chew on in the U.S. market.
It sounds that way. And presumably there are market estimates for just how big that scale is in the U.S. How many billions are we talking about?
So when we floated, it was 1.7 to 2 billion. Now they're saying it's 4 to 5. But what's happening in this segment is the market is being redefined. At first, it was background screening at the inception of employment. But now, with the changing in legalization of drug laws, with what's going on with the gig economy, where one person doesn't have one job anymore, they have 2 or 3, and those jobs are geographically in demand, this is becoming a much more fluid piece of the human capital experience. So we're screening constantly, we're monitoring for sex offenders, rescreening, no notices. They're having a difficult time really defining what this market is. If you think about it, it's all about the information and value of the individual, and that as jobs are becoming more distributive and more ad hoc, that information value is starting to increase. So what's the cap on the market?
Yeah, and access to that market presumably again comes back to technology and investing in that technology.
Mobile.
There we go. Nice simple answer. Great. Well, that's very helpful. Perhaps we might just have a word with David on the numbers now, and then come back to you for a summing up. Thanks, Bob. Right, pleasing set of numbers, David. What was the most pleasing thing? EBITDA positive must have been a hurdle that everybody's been focusing on in the last few months.
Yes, absolutely. We're very, very pleased to see the numbers and EBITDA positive for the first H period this year, which is good. We got revenue growth, we got OpEx flat, and we got EBITDA positive. So a good set of numbers in the books.
Mm-hmm. And looking at the revenue growth, again, pleasing fact, all organic, I think, is it?
Yes.
There's nothing that's been added on during the year.
Yes, that's correct. It's all organic, and if you take a little bit longer look, the last 3 years has been organic growth where we've had revenue grow 32% and operating expenses being flat for those 3 years. So is what it's resulting in the positive EBITDA.
Well, that's, I think, one of the more powerful slides in your deck. Just how have you kept expenses flat for 3 years, if not fractionally declining, whilst overseeing very good double-digit top-line growth?
Mm-hmm. A lot of it was gaining efficiencies throughout the organization, and we're just making better use of our resources across the board. We're picking up expenses and efficiencies throughout the organization, and it's just good to see that we can do that and maintain the quality of services that we have for our clients and for employees.
Mm-hmm. And will that continue? You're talking about internal efficiencies, but as the business is growing, there will be an increase in headcount, presumably.
Absolutely.
Can you keep on, I suppose, balancing the two?
Well, absolutely. Certainly, the internal efficiencies will continue and improve. On the other side, we will see. We anticipate seeing a slight increase in operating expenses next year because we're in a growth mode and it's time to grow. The demand for our products is increasing. We are making increases to our sales force, and also our development of our product will increase. The rate of change will increase because of what we're seeing in the marketplace. So we're entering an accelerated growth period.
Mm-hmm. And let's just have a few words on the balance sheet. You are cash generative as a business,
Correct.
Which is again also very relaxing for a finance director. But you have a line of credit saved away for a rainy day as well.
Exactly. We are cash flow positive, which is great to see, and we have a $5 million line of credit with Silicon Valley Bank that is unused, which is great. So we have a full availability on that if needed. So we're in a good shape from a cash situation.
Okay. Maybe we'd just look at some of the revenue drivers of the units. Bob was talking about medical MIS being very much in good growth mode. How important within the group to the revenues is MIS?
Extremely. It's our fastest growing division. It grew at 27% in the first 6 months of this year, and it was 40% of our total revenues. So when you have 40% of your revenues growing at 25+%, and we see that sustainable. Most importantly, and why is that? It's because of we have a market leadership position with our product in that space.
Very good. And next biggest would be direct?
Correct.
Mm-hmm.
Correct. And direct is also a fast-growing unit. We continue to resource that more heavily with salespeople and technology, and we see that growing also north of 20% in the future. So the combination of those two divisions, Andy, is 2/3 of our business. So when you have 2/3 of the business growing at over 20%, that's a nice place to be.
Yes, if you were a fund manager and your two biggest weightings were performing the best, you'd be a happy man.
Exactly.
And looking at the overall margin for the business, there seems to be an element of mix coming in different ways from that group, from the growth, presumably because a lot of your technology is used by your clients on I would say a white label basis.
Correct. We have a very strong gross margin company-wide, 57%, which is very strong gross margin. And now that a lot of the operating expenses are fixed, we have tremendous operating leverage moving forward, where the incremental sales, incremental revenue is going to drop a lot to the bottom line.
Nice situation to be in. And currency, not really anything for you to worry about in terms of variation, even for the Mexican business mentioned. Is that still billed at US headquarters level? Or?
Yes, yes. And with 95% of our revenues generated in the US dollar, the US dollar has been extremely strong recently. It's nice to be, because we have the power of our currency for us working well in the marketplace.
Great. Well, I look forward to you coming back in 6 months, David, and reporting yet again flat expenses, which is a very nice way to underpin growth.
Excellent. Thank you, Andy.
So what about the future, Bob? I think reading our reports, one of the attractive features for investors in your business seems to be the visibility looking into the rest of this year and 2019. Is that a true judgment to be making of visibility of earnings coming through?
The visibility of earnings are pretty consistent. Remember, we're contouring and modifying our technology to meet the operational workflow of the client, usually integrating with other systems. So once that's done, we have a level of stickiness and elasticity as far as dealing with the clients. So we have over a 90% reoccurring retention rate of the clients that we have done business with this year moving into next year.
So visibility is good. Growth will continue for the reasons that we've talked about in the marketplace, and greater appreciation of your USPs. And in terms of finances for the business, there must be a lot of operational gearing, given what David was saying about the very flat structure of expenses as your revenues grow. So bottom line should be quite an optimistic outlook as well.
Agreed. I mean, we're at a position right now where gearing is a good word. We've now gotten to the maturity level where we understand what the level of volume impacts our business, how to make efficiencies, make adjustments, where we focus our pursuit of what markets to keep those adjustments in line. So we see a lot more drop through in the upcoming year.
Drop through, another good word as well. And then perhaps lastly, there's so much organic growth. Does this mean that M&A is unnecessary, or do you think there might be opportunities to add on products or people in teams that would accelerate this growth?
If you had asked me a year ago, I would have said yes. But where the U.S. market today is, and the kind of companies that we would have to approach to get a quality sales funnel, the asking price for those companies is so astronomically high, it would be difficult to make them accretive. From a competitive standpoint, because there is such abundance now in the labor pool, it really makes more sense to put money into doubling down on the sales effort than it would to make any acquisition.
Yeah. And you have been making 1 or 2 hires on the sales side from a very low base. So the interim success that we've been talking about was achieved with a very small number of dedicated salesmen.
We had 2 and at one point 3 salespeople. What we've done in the first half, and this will be the first time we've done this, is we've recruited a very senior chief revenue officer who is bringing on a team and really refocusing the depth of our sales funnel and redefining the metrics of our sales funnel so that we can reasonably look into next year in 2019 and understand how much we need to have in queue to be able to produce the kind of numbers that the market would expect.
And are these people coming from industry with a recruiting background or from competitors?
They're coming from competitors, and of the sales people we've brought on and the way we have targeted the requirements for that sales model, we are bringing on no salesperson with less than 10 years enterprise level experience.
Great. Well, last question. What can go wrong then? What keeps you awake at night, Rob?
As far as the business prospects, what keeps me awake at night?
Yes.
So there are challenges. If you look at the marketplace, there are always going to be challenges. It's a fast-paced market. This is very much a land grab environment. Companies are trying to get as much footprint as possible. If there's anything that I think we're concerned about, it's velocity. Getting in there as quickly as we can. Keeping the channels of industries that we've already established as targets and try to run through those industries as quickly as possible. So now bringing on those salespeople, I'm starting to get a little bit more comfortable with that, but that's really the tip of the spear where that's the thing that I'm most concerned with.
Well, you don't look too worried at the moment, which is reassuring for shareholders. So thank you both. For those of you who are interested in a third-party assessment of the prospects of ClearStar, there is, of course, a recent note from our own Paul Hill that is available on a website. Good luck with the rest of the year, gentlemen.
Thank you, Andy.